Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Tuesday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So I wanted to do a longer analysis of the market following Friday, where we had this dramatic swing in mortgage rates and really what I felt was an overreaction, and there's been a little bit of a correction, still a bit of a jump to the conclusion that we're for sure going to have a recession. And I want to kind of talk through why I don't think that's quite a certainty just yet. So again, what happened Friday was we had an unemployment rate that came in higher than expected and job openings that came in a lot lower than expected. And they were both far from the expectations. So it was understandable for there to be some movement. Like I said, on Wednesday, my reaction to the Fed's comments after their decision not to do anything with rates was, if we saw economic worsening and inflation comes down, we could see a 50-point rate cut at the next Fed meeting. This was certainly indication that the job market is slowing, so there should have been some level of movement towards a 50-point rate cut. However, it swung so dramatically. A week from last Friday, there was 11% chance of a 50-point rate cut. At one point, it was 80% chance of a rate cut. Then on Monday, yesterday, there was a point in the day where there was a 90% chance of a 50-point rate cut and a 10% chance of a 75-point rate cut. There was no chance in the market's view at that point that we would have a quarter-point rate cut. In my mind, the only way a 75-point rate cut in September, there should be even an iota of a chance, is if we have just a massive uptick in unemployment. If we go from 4.3% to 5% by September, sure, maybe 75 points is on the board. I just don't think it's that certain a likelihood. Listening to Jerome Powell's press conference on Wednesday, you got a lot of insight into where the Fed's members' heads are at. Someone asked him a question, and it was a good question, about the SOM rule, which is typically an indicator of when a recession is going to happen, when you have basically a certain uptick in unemployment over a 3-month period. And we were going into that meeting right on the edge of hitting that SOM rule threshold. And then as of Friday, we topped that threshold. But I think Jerome Powell's response was important. He kind of dismissed that, brought up the fact that we've had an inverse yield curve for over 2 years, which typically has indicated a recession. We have yet to have a recession. What has in the past been an indicator of future recessions, I don't think they really care about, because this economy is unique to past economies. That is the big takeaway I had from his meeting. So while I still feel very confident that we will have inflation continue to come down, as I've talked about before, I think shelter specifically will start coming down more sharply during these summer months. That will help. And I think it's more likely that unemployment goes up than it flattens or comes down at this point. But I don't think yet there's enough indications that unemployment is going to skyrocket for me to say this is going to be a for sure recession. Could there be? It's definitely possible, but this is just one report, and I think the market definitely overreacted to it. Now, as of today, as of this recording, there has been correction. I think we're getting to a more stable place. Last I checked, there was a 67% probability of a 50-point rate cut, 32% of a 25-point rate cut. I think that's much more in line with the reality of where we are right now. Now, next week we'll have CPI, Consumer Price Index. If that comes in really low, then definitely that will change things, and the probability of a 50-point rate cut should go up to some degree. But I think this particular report, the fear-mongering and the media took hold and blew it into something that it's not necessarily, which is that we are for sure facing a recession and there's nothing anyone can do to stop it. But it's definitely something that is worth monitoring, and I'll probably be doing more of these updates while things are in flux. The big report that's going to be crucial to follow now that unemployment has started to tick up, is initial jobless claims. This report comes out every Thursday, and it has started to creep up. That's why I wasn't surprised we had an increase in unemployment. The markets were projecting us to stay flat, but with initial jobs creeping up, it wasn't a real shock to me. If we start seeing initial jobless claims in the 250 or higher range, then I'm going to start to feel more concerned that we're heading towards a recession and unemployment will continue to go up. If it can even just stabilize to like the 230 range, which is higher than it had been earlier this year, but is where we've been for the past 2 months or so, that's an indication that the unemployment rate's going to stabilize, and I would feel less concerned about a recession if that happens. So, as always, if you have any questions or comments, shoot them below, or feel free to call, text, or email me anytime. But thanks for tuning into this video, and I'll see you next time.